CAE Inc. beat revenue expectations in Q4 fiscal 2026, and that number is almost irrelevant to the allocation decision now in front of holders. The company's civil aviation training segment, the segment that carried the secular pilot shortage thesis, has had its Middle East training center shut down, and management did not frame that as a temporary closure. The thesis that drew capital into CAE rested on a post-COVID structural argument. Airlines worldwide faced a generational pilot shortage, and CAE was the dominant provider of the simulation and training infrastructure needed to close that gap. That argument still holds globally, but it contained a geographic assumption that the Iran war has now invalidated. The Middle East corridor had become a growth engine for CAE's civil aviation business, not a minor outpost, but a region where airlines were expanding capacity and actively sending pilots through training cycles. When the Iran conflict erupted and airlines began grounding flights or cutting regional capacity, the demand for CAE's training services in that geography collapsed, not moderated. The distinction between collapse and moderation is the one that repositioning pressure on this stock turns on. A moderation means holders wait 1 quarter, and the segment recovers with the news cycle. A collapse means the revenue line for that geography does not exist while the conflict continues, regardless of what happens globally. Before the Q4 results, BNN Bloomberg analyst Teltscher named CAE a top pick, citing the long-term pilot shortage supercycle. That call was made on the secular frame, before management confirmed the profitability miss and multi-quarter forward guidance on disruption. The timing gap between that recommendation and the earnings confirmation is the observable participant asymmetry here. Analysts positioned on the secular thesis before management quantified the geopolitical exposure, and the repositioning pressure that follows that gap has not yet fully cleared. What the thesis break does not answer is how deep the impairment runs, and that question depends on a mechanism that operates outside the aviation training market entirely. The conventional read on CAE's Middle East exposure treats it as a single-cause problem. Conflict disrupts regional air travel, training demand falls, segment margins compress. That framing misses a second channel running simultaneously, and the second channel is what converts a geopolitical disruption into a structural demand problem across the civil aviation segment, not just the affected geography. Brent crude at 103.40 and WTI at 96.89 reflect a Strait of Hormuz that remains largely closed. 20% of the world's oil and LNG used to pass through that choke point in normal times. Airlines are not just cutting Middle East routes, they are absorbing fuel cost increases that compress their operating margins globally, which directly reduces their capacity to fund pilot training cycles at full volume. As a countersignal to the recovery narrative, U.S. consumer sentiment collapsed to 47.6 in April, the lowest reading in the 74-year history of that survey, worse than 2008 or the COVID shock, and nearly 27% of U.S. consumers have already cut discretionary spending, with airlines and travel among the named affected sectors. That consumer pullback suppresses the forward booking demand that justifies airlines maintaining or expanding their pilot training pipelines in the first place. Then the Federal Reserve layer. Fed minutes from the April 28-29 meeting show officials open to rate hikes if inflation does not moderate, with markets now pricing a possible hike by late 2026. Higher rates on top of fuel cost inflation means airlines face a compressed margin environment on both their cost side and their revenue side. And when airlines compress, the first discretionary item they defer is simulator time, not the routes they are already contractually flying. This is the mechanism the pilot shortage thesis did not price. The thesis assumed airlines would remain financially capable of training at pace, because the shortage created its own urgency. The Iran war has inserted a cost shock that makes airline financial capacity the binding constraint, ahead of the structural pilot shortage urgency. The position pressure change that makes this legible as a capital flow event on CAE, rather than just a sector story, is that institutional holders who sized the position on the thesis that airlines would fund training regardless of the macro cycle now face a fundamentally different conditional. What remains unresolved is whether management's transformation plan can offset enough of the margin compression to keep CAE's operating leverage intact while both channels run. Management explicitly guided that the Middle East disruption and its profitability impact will continue across multiple quarters, not this quarter, multiple quarters, and that distinction is where the holding period question for CAE becomes live. A single quarter disruption reprices at the next earnings release. A multi-quarter disruption requires the holder to carry the position through an earnings impairment cycle, whose end date is determined by a geopolitical negotiation, not a corporate operating decision. The transformation plan CAE announced, targeting significant cost savings to rebuild operating leverage, is structurally the right response, but it operates on a different timeline than the disruption itself. Cost restructuring programs take quarters to flow through to reported margins. The revenue hole from shut training centers opens immediately and stays open as long as regional airline operations remain depressed. The analyst community noted after the Q4 release that the recovery timeline remains uncertain given the open-ended nature of the Iran conflict, and that uncertainty is not priced the same way by all capital classes on this stock. Institutional holders who entered on the secular thesis carry lower cost basis and longer intended duration. They are the class least likely to have repositioned on the Q4 guidance alone. The capital class that has not yet confirmed its move is the segment that sized CAE as a cyclical recovery trade rather than a structural compounder. That positioning, entered on a shorter horizon assumption, now faces the multi-quarter duration management just guided. The checkoff anchor from the opening holds here. Rebecca Teltscher's pre-earnings call named CAE on the pilot shortage supercycle frame, and the Q4 results confirmed that frame is intact globally, but impaired geographically for an undefined multi-quarter window. The verification benchmark for that thesis is not a peace deal announcement. It is the observable resumption of Middle East airline capacity at levels sufficient to restart training demand in the affected centers. A ceasefire does not automatically meet that benchmark because airlines do not immediately rebuild routes that weak a conflict pauses, and CAE's management already baked multi-quarter disruption into their guidance, even under de-escalation scenarios. The Strait of Hormuz remains the physical threshold. The strait is not formally open. Iran Navy coordination allowed only 26 vessels to transit over a 24-hour window, and the oil price remaining above $100 per barrel signals the market's assessment that the constraint has not yet resolved. The monitoring variable for this stock is not the peace talk headline. It is the oil price crossing back below the $100 threshold and sustaining it, which would signal that Hormuz transit has normalized enough to begin reversing the airline cost shock that feeds the second demand destruction channel. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.